earnings were so much greater than what they were the previous 2 quarters. So I left a lot of money on the table by not realizing that the earnings of these gold companies would go higher and higher and higher. Even though gold had gone up and come down, the new price had still brought them a huge profit to the bottom line. So I've already talked about that in my newsletter to our members that, hey, don't make the mistake that I did. And the stocks move on a different modality, different paradigm than the metal itself. So there's that. So much to cover there. I'll try to summarize it. So we have had, well, first of all, we're in a very strong secular bull market. And as far as I can determine, we're in the final phase, which means we get the most acceleration in price in a rather short period of time. And so that's number one to bear in mind. Number two is, in these times and a major bull market at the end of the cycle, we see drastic moves up and down. And this is the function of a bull market, is to shake off, scare out as many people riding that bull market as possible. And we saw that recently. Just for context, we had a very good market in 2025 for gold, silver, platinum, and palladium. All four moving together is confirmation of a major bull market. We saw silver and platinum actually lag up until April or so of 2025, and then they took off and exceeded gold's move rather substantially. So both platinum and silver were up 140% for the year. Silver went what I would call double parabolic in January, up almost 70% for the month. And that was scaring me, Vlad. Not that I didn't like to see it, and my account looked pretty good, but you don't count your chickens until they're hatched. And I was warning everyone, public and private, my private work as well as interviews like this, that it was going to come down. And it's probably going to come down hard. And it did. And of course, many people are mistakenly saying that this was the largest one-day sell-off in the silver market ever, which is not true. If you go back into history, and I was there, I was a young enough man at the time, so my age now. Point is, Silver Thursday, March 27, 1980, silver went from almost $21 an ounce to about 10. So it was like a 50% cut rather than a 30% cut. Nonetheless, that big move from like the 120, 124, whatever the top tick was, down to 78, I believe, that day, definitely shook out the market. But that's to be expected, unfortunately, especially when you get an acceleration. What's ironic about it, Vlad, is if you took the first day of 2026, which I think was the 2nd of January, and the day of the 30th, where it ended at, I think, 78, the market for January was still up 10% for the month, which is crazy. Because if I had told you ahead of time, hey, look, Vlad, we're going to end January with another 10% gain in your silver price, you say, oh, wow, great. But since it really just went, rocketed up. So there's point number two. Point number three, probably as important as point number one, is this. We are in a situation, we meaning precious metals investors, or the silver market, you can think of it in those terms, is in a new dynamic. The new dynamic is price discovery based upon physical demand. And that's what's been driving the price for the last several months, up until we saw this big sell-off on January 30th, where the paper paradigm took over control of the market, and I'll put in quotation marks, temporarily. So now we're kind of in a battle between physical demand for silver on the commercial bar side versus the paper quantities on the commercial bar side. And right now, the paper people are winning. And I think that's going to go back and forth a few times. The only caveat is I could be wrong. I doubt it, but we could be in a situation where the physical demand for hard metal commercial bars has been satisfied temporarily. So for an example, Vlad, let's just say that Samsung, 3M, Tesla have all got their hands on enough physical silver to satisfy their personal demand for industry for the next 6 months, 6 years, whatever their timeline is. And they don't want to buy anymore right now. They've got it locked in, and that demand is gone away. Now, I really, really doubt that. But if that is the case, then we're going to have to rest a while before that demand comes back. Now, that doesn't negate investment demand, which could take over and continue this bull market based on physical supply. But it might not, because most of the investment demand is price-based, meaning I'm only going to buy silver when it does. And there's all kinds of algorithms out there, but until it gets above the 10-day moving average, 20-day moving average converted by the 10-day moving average, and the volume is at this level, then we'll go in and buy. I don't want to get too technical here. Overall, I'm still bullish. I think we've done enough damage, or if you want to call it damage if you're long, to have to rest a while, probably establish a trading range, and then determine if the physical market, as I just said, is gaining control again and we start marching up again.
Silver's recent surge was extraordinary, a near double parabolic advance that stunned even seasoned investors. In January alone, prices climbed at a breathtaking pace before collapsing sharply. Yet context matters. The 30% one-day drop, while dramatic, pales compared to the 50% plunge on March 27, 1980. Volatility is not new to silver. It is embedded in its DNA. Even after the sell-off, the monthly performance remained surprisingly strong. These violent reversals are characteristic of overextended markets. When momentum becomes euphoric, corrections follow swiftly, not as anomalies, but as essential resets within a larger cycle.
I've said many times, Vlad, 90% of the movement in the last 10% of the time. And I've been saying that for years. And I also went back and looked at the actual arithmetic in 1980. And I forget the exact numbers, but it was like 87% of the move came in the last 8% of the time. But it's just a rule of thumb. What it really means is there's a big move up in price in a short duration. So if you look at a 25-year bull market, 10% is 2.5 years. Gold broke out at around the 2000 level. So we might have a year and a half left basis that metric. Well, what happens next? So we'll peak in a parabolic function like we just did in silver. Some people are saying that is it. That's the move, and you missed it. I don't think so, but I'm not 100% certain, especially basis the gold trade. Anyway, what does happen? Well, what's occurred in almost all cases that I'm aware of is that it peaks in a parabolic move. Some very few get out the top. The market starts down and then it corrects down. So it gets overbought, overextended, and really overvalued. And when it's overvalued, overbought, and overextended, it has to correct. And it comes back to being fair priced. And then it establishes a range at the fair priced level. And you see people that are disappointed, they missed the top, but it's still much higher than it was from the breakout, like you just outlined for silver. That's what normally happens. Now in silver, the last time we got it overbought, overextended in a major way was in 1980. It happened again in 2011. In both cases, it dropped. In 2011, it dropped to a new high, $30 range, stayed there for about a year, and then it folded and came way down. I think this time it'll act more like gold, what I just outlined. It'll drop and establish a new fair value price. I don't think it will do what it did in 1980 or 2011, where it really crashes over time. First of all, the cost to mine it will be higher. At that time, I expect oil costs or oil price to be substantially greater than it is now. And lastly, this industrial demand is like 65% of the market. That's not going away. So I do think we'll see a reestablishment of quote unquote fairly valued gold and silver after the peak.
A new dynamic has emerged in the precious metals arena: physical price discovery. Industrial users, from manufacturers to technology giants, have increased demand for tangible supply. Yet futures and derivatives markets still exert powerful influence. When paper selling overwhelms physical buying, short-term price suppression can occur. This tug of war defines the current environment. If industrial buyers have temporarily secured sufficient inventory, prices may consolidate. But with silver's industrial usage now exceeding 60% of total demand, driven by solar, electronics, and EV production, long-term structural support remains intact. The battle between physical fundamentals and financial speculation is far from over.
Too busy not to. Actually, I called and I was on the phone to pull the trigger, and it was so hard to sell at the top because so few people were buying. But I did put an outline out to my paid members with a very concise, deliberate guidance to sell into the rally. Sell, for example, 20% at $80 silver, 20% at $90 silver, 20% above 100. Hold 20% in case we go into hyperinflation. And then on the way down, if we establish a 10-day average trading below this level, then sell more. Because the last thing you want to do is go from 50 to 120 and back to 50 if you got in at 50 and ride it all the way up and all the way back. So this guideline gives them. So I had 3 or 4, I'm sure it was more than that, because usually every email you get is like there's 10 people behind it with the same question. That's a rule of thumb, not an exact number. But I had about 4 that got out, and they got out in the hundreds. And it was very difficult to get out at that real price because most dealers were bidding back $15, $20, $25. But I interact with a hedge fund manager friend of mine that gives really fair prices on the spread. Very low on the buy side and very low on the sell side. In other words, you're getting the best price by buying and you're getting the best price by selling. And I guide all of my members to that entity. Some use them, some don't. I'd say at least 90% of our membership uses them. And so they were able to escape that huge, delta, that huge difference between the spot price on your computer versus what they were actually paying. So that made me pretty happy because, I want people to get the best price of buying and selling. So that's something to note. Other than that, no. What did I do? Really nothing. I was going to lighten up on not just the silver, but my platinum position. I didn't. So I did not. Stock-wise, yes. But my stock portfolio is not even 50% of my overall holdings now at my age. And I'm long-term. I think most of the stocks did get maybe, I wouldn't say overvalued per se, but they made a nice run. And so I did take a little bit of profit there, but that wasn't at the time. It was prior to that. A friend of mine that's a very good stock analyst that works for me suggested maybe taking a little bit off the table. And at the time I thought, yeah, why not? We did. And looking from today, Vlad, I'm glad I did.
Every parabolic advance follows a familiar script. Prices overshoot intrinsic value, early participants quietly exit, and late arrivals chase momentum. Eventually, gravity reasserts itself. Markets retreat toward what can be described as fair value, a level where enthusiasm cools and rational pricing returns. In 2011, silver peaked and then retraced significantly before entering a prolonged consolidation. The 1980 episode followed a similar emotional arc. This time, structural factors such as higher mining costs and sustained industrial demand may prevent a total collapse. Instead, we may witness a reset, not a ruin, before the next leg unfolds.
I think, Rick's a very smart guy, and I haven't spoke to him one-on-one in quite some time, but I did have him on my mastermind series a few years back, and I was actually not astounded, but a little involved as from how much we think alike, because, I focus on the blue chips. Certainly we do speculations and mid-tiers. We look at everything. We look at uranium, we look at lithium, we look at copper, just like him. We look across the spectrum. We're not gold and silver only, although that's where the bulk of our investments are currently. it's moved around sector to sector with more emphasis depending on the metal du jour, what's really popular and moving. Having said that, I really agree with him that the best value is in the mining shares and probably in the top tier currently. There's always value across the spectrum, but you got to be careful in the juniors because you get a washout like this, it harms them all. But you got a lot more liquidity in a major than you do in a junior. So I think he's on point. I know I learned that lesson the hard way. I'll just be brief, lad. But in 1980, when I sold most of my gold at 700, not the top at 850, I sold the mining shares roughly at the same time. Think, oh, gold's peaked and the shares have peaked. And I did the one-handed salute, going, oh my goodness, 6 months later, what did I do? Because the average price, remember I said it goes up and it reconsolidates. From memory, I think it was around $600 gold was kind of the average for the next year or so. Well, the price of gold was hitting a new all-time high at $300 gold in December 1979. That's when I started my big, not big for me, my little, investment in futures, which for me was big for my age and, size of what I could invest. But anyway, the mining shares just kept going up and up because the earnings were so much greater than what they were the previous 2 quarters. So I left a lot of money on the table by not realizing that the earnings of these gold companies would go higher and higher and higher. Even though gold had gone up and come down, the new price still brought them a huge profit to the bottom line. So I've already talked about that in my newsletter to our members that, hey, don't make the mistake that I did. And the stocks move on a different modality, different paradigm than the metal itself. So there's that.
Mining equities operate under a different logic than metals themselves. When bullion prices rise, miners' profit margins expand disproportionately. Even if metal prices pull back modestly, earnings can remain robust. This dynamic was evident after 1980, when mining stocks continued advancing despite gold retreating from its peak. Today, many analysts argue that senior mining companies offer stronger liquidity and resilience compared to junior explorers, particularly during volatile corrections. While metals capture headlines, it is often the disciplined investor in quality producers who captures sustained gains during the consolidation phase that follows a price surge.
I don't want to be disingenuous. I do not like the fiat system, but that doesn't mean that you don't have to have some. And it is a cushion. It's the way we trade. I exchange fiat for money. I take it to the coin dealer and get real metal. So yeah, I think it is always good, especially if you're on leverage, which, I teach most people not to ever touch leverage, but you can. And so, no, it's good, especially in these big, drawdowns or pullbacks like we've seen. It's nice to have a cash buffer there. And so I don't discourage it. As far as, long-term savings, I think your long-term savings should be in gold and silver, and that's proven to be correct over the longer term. But in the short term, it's always good to have a cash buffer. Well, it's significant if the market thinks it's significant. A lot of this news, a lot of people think that the markets move on news, and it does somewhat, but not nearly to the extent that most people think. Robert Prechter did a great study on it. Others have done studies on it. And it's more talking points for the mainstream financial channels than anything else. Having said that, yeah, it could have some effect. Interest rates are important, and the Fed does set the discount window, and that does affect markets. So there is some merit to it. I think, and have for some time, that the general equity markets worldwide, but particularly in the U.S., are overvalued. We saw 50,000 on the Dow. It's under that now. Market looks like it is set up to come down. I made a call on that basis, stock cycles guy that I trust, and I was wrong. He was wrong. I won't blame him. I put it in my report for, I think it was October, November of last year. Nothing really happened. But I still think there's a good chance that we will see a pretty sizable correction in the Dow and the S&P 500. However, my overall thesis has changed probably a couple years ago that in a true inflationary slash hyperinflationary environment, the stock market just goes up and up and up and up and up and up because people look to get out of the dollar, excuse me, whatever currency they're in, and put it in the stock market, which is a place to, hide or protect your money because it's losing such value so rapidly. You're better off in the stock market than in the bank, and that's true. But in a real strong inflation, the only place really to hide is generally gold and silver. And so even though the stock market might be making new all-time highs again and again and again, it's not keeping the pace that gold and silver are doing. And we saw that last year, which leads us to think that maybe we are getting into an inflationary environment where the debasement trade, the depreciation of the currency is happening so rapidly that more and more people are moving into gold. That's what it appears to be happening. Said Vlad, and I think, the market does speak to us if you know how to listen or where to look, as you just outlined. But a lot of people don't know where to look. They don't know how to price the Dow in terms of gold. And as you said, if you did that, you'd see the peak was in 2000. So, but in terms of but the Dow's making new numbers. It's at 50,000. So you really do need to know. And I was taught or learned that very early, luckily, because I've been such a advocate for how does the monetary system really work? How does the banking system really work? What happens in a fiat structure and all those questions. And one of the first books I read was called The Invisible Crash by Jim Dimes. And he taught us all that read the book to price the Dow in terms of gold and see what it's really doing. That's why it's the invisible crash. In terms of Dow numbers, it looks fine. It's going sideways or it's going up. But in terms of gold, it's going down. And gold's the constant. That's what people need to be reminded of all the time. Gold doesn't change. Well, gold's at 5,000. Well, gold was gold at 500. Still the same ounce. What's changed? What's changed is how much funny money they've printed between the $500 gold and the $5,000 gold. And gold is signaling that, hey, I'm still here. I'm still 1 ounce. But now I'm revalued in dollar terms by a 10-fold increase, which means was the economy down 10 times? No, it's not. But it does mean that the currency has been debased, perhaps by that amount.
The broader story extends beyond metals alone. In a fiat-based monetary system, asset prices must be viewed relative to currency value. When priced against gold, major indices such as the Dow Jones Industrial Average often tell a different story than headline numbers suggest. Nominal highs can mask real declines in purchasing power. In sustained inflationary environments, equities may rise, but gold frequently outpaces them, signaling currency debasement rather than genuine wealth creation. The lesson is clear. Measure performance not only in dollars, but in real terms. Markets speak if you know how to listen.